Welcome to today's Cup of Joe. If you came to our forecast event last week, a lot of people had fun with Jenga towers. Some people's Jenga towers fell sooner than others. And we don't know when the Jenga tower is going to fall for our economy here in the U.S. But one thing that we want to look to is the yield curve. Now, if you weren't able to make the forecast event, please stay tuned because we'll be coming out with a webinar for this in the near future. Davey will let you know when that's going to be. But these yield curves, they typically invert prior to recessions. But we usually don't get into the bad part of it until they go back to normal. And what you can see here is the percentage of the bonds that are shorter than the 10-year, that are above the 10-year during the inversion process. And some of these, during some of these periods for recession, we had 100% of the curve above the 10-year prior to the recession. In this case, we're again above 100%, but we've already come back down to 80%. Pretty soon we may be at 50%, but by the time we're back to, everything's back to normal on the yield curve, we're probably going to be in a recession. Now, people look at which way things invert to kind of tell, is it going to be a soft landing or a hard landing? And a lot of times people are looking at, are the short-term rates coming down faster than the long-term rates, or are the long-term rates actually going up? And a lot of times people think, well, if the long-term rates are going up, that means that people think the economy is going to be stronger in the future. That's a good thing. But there is another reason that might happen. And the other reason is that people just don't want to buy our treasuries. And this is what happened at the end of October. We almost had failed auctions at the end of October, and that's what drove the long-term treasury rates higher. And so we had the 10-year treasury rate approaching 5%, the 30-year treasury rate approaching 5.3%. And that's come down a good bit since then, but it may head back up. When would it head back up? The Treasury has been issuing shorter term rates recently, and a lot of people have been having a lot to say about why they switched to shorter term rates and things like that. But they're actually pulling money from the Fed. The Fed's been allowing banks to buy up money in the reverse repo market instead of buying treasuries. But recently, they've been taking money out of the Fed and going back into the treasuries, and that's been funding the government for the last few months. We had over $2 trillion that the Fed had allowed money from the banks to be deposited, but that's been spent down. And it looks like it's going to be spent down by the end of March. And if that happens, there's going to be a lot less money available for the Treasury to help fund the government. Of course, we'll have tax receipts to help in April, but after that, it may be that the Treasury has to go back to finding other means to help fund what they need to fund the government. And it may be that they're going to start issuing longer term bonds again. If they do that, that's most likely going to start driving the yield up and drive the price down, because there aren't that many people that want our bonds. And so it may not necessarily mean if the prices go down and the yields go up on the long-term treasuries that people think the economy is going to be stronger. It may just mean that nobody wants our treasury bonds. So keep that in mind, and please feel free to like and subscribe to the channel, and like the video as well, and share with your friends, and we'll catch you next time. And keep your eyes posted for the webinar where we're going to cover a lot more on these things and more down the road.